Daniel, thank you so much for joining us here at RiskMinds. What would you say are the greatest challenges facing the banking industry and indeed the insurance industry at the moment too?
I think the banks face a number of challenges from different stakeholders. We're 10 years since the financial crisis, so that period has been a period of challenge from the regulators. So the regulators have been very clear. They want to see better capital, higher capital, more soundness, less variability in risk-weighted assets, and greater liquidity in the banking sector. So there's been a really strong regulatory focus since the crisis. There's also been challenges from the politicians. Politicians obviously want the country's economies to grow, but at the same time they want to see stable banks. There's been pressures from that stakeholder there. Been pressures from competitors, so startups, other fintechs, other firms coming in to see whether they can be more nimble and take the business from the banks in a more effective way. There's been challenges from their customers who want to have obviously products that work and stable banking sector. So there's been a lot of pressure from all the different stakeholders that they face, and they have a lot on their plate at the moment. On the insurance side, it's probably slightly different challenges in the sense that the insurance sector has the wind keeps blowing, so losses are coming in. We had a very exciting quarter at the end of last year. We had the famous HIM, the Hurricane Irma, and the Mexico earthquakes and other issues which caused over $100 billion of insured losses. And this year, as I said, the winds have blown again. We've had issues with California. We've had Typhoon Jetty, we've had Hurricane Michael, all of which have been over $25 billion of insured losses just in the sort of natural catastrophe arena. So interestingly, that dynamic actually brings the expectation of rate increases, which brings more capital to the industry, anticipation of expected rate increases, which actually leads to less rate increase because there's more competition. This year we're expecting to see about $100 billion of investment from alternative capital sources, which is about 16% of the total reinsurance capital in the world coming from alternative capital sources. So we think that's considered to continue to grow. So the insurance industry has a challenge around yield. How can it make the yield for its shareholders in a similar way to the banks as well? How can it keep relevance in the fast-growing economy moving forward? And therefore, how can it continue to evolve its products and services for customers moving forward?
You talked there about relevance and evolution, and you'd like to talk, I think, about a collaborative approach with the banking world for the insurance world too.
Yeah, I think that's a very good point. I think we're obviously from the insurance side, facing into the banks, and I think from our perspective, I think someone said this morning, really, it's where right today there's a real opportunity for Risk to be a real strategic business partner in the banking sector. So rather than Risk to be driven by compliance, which has to a degree, it actually should be an enabler to help banks be more competitive, help banks build better products, help banks be more sustainable, and therefore, in our view, the insurance sector provides should be a key partner in supporting risk management in the banks in terms of in their journey to become enablers rather than compliance functions in the banking sector.
And that enabler role has to be bolstered hugely by the proliferation of data and perhaps the use of technology too.
Absolutely, that's really where we see a lot of exciting things happening. So from our side of the fence, where the insurance industry gets comfortable with the risks that they need to be able to take on board on their balance sheet for the banking sector, that requires transparency of data, that requires understanding, that requires a degree of trust. And when we bring those ingredients together, the ability of the insurance industry to respond to the banking sector needs is really, really quite exciting.
So to become that strategic partner, what must your industry do, and how nimble do you have to be to sort of stay ahead of the game, if you like?
I think it's a question of building products which are for the customer, or customer solutions rather than products. I think the insurance industry, perhaps particularly in the banking sector, have tended to sort of hide behind their sort of banner of available products, whereas where we see more greater growth is where we solve problems rather than try to working with the banks hand in hand and come up with customized solutions rather than a range of products. To give an example, over the last 4 or 5 years, AON has been working with some of the government agencies in the United States, helping to de-risk Freddie Mac and Fannie Mae in terms of diversifying the US retail mortgage risk into the other asset pool, into other pools of investors. And the reinsurance industry has invested very heavily in that and has taken on over $20 billion of the exposure into the reinsurance sector. And the advantage for the US government there is you're challenging what's already been underwritten, and you're moving some of that risk and pricing that risk into the secondary market, which is helping to spread that risk. And that's worked really because of the granularity and the confidence that the insurance industry can get from those sorts of transactions.
And that's what a modern customer expects, those sort of approaches as well, perhaps, that, you know, whether it be kicking and screaming, the financial institutions have been sort of brought into the 21st century by what the customer demands too.
Absolutely, that's absolutely right. I mean, for banks, for everyone to be relevant, we need to have compelling products, and that's really where we believe it's a true partnership. But it has to be a partnership between the insurance industry that is there to support the banks, both in terms of validating what they're doing, challenging what they're doing, providing a different asset class to diversify their risks, and obviously giving them the peace of mind that if things go wrong, there's a financial benefit too.
So despite the sort of huge geopolitical sort of landscape that we see that's so challenging ahead, and possibly, you know, economic challenges if we are looking at the end of a cycle, you're very positive, it seems, and optimistic about what role you can play going forward.
We are. We believe that we all live in uncertain times, and no one can control some of the geopolitical situations happens, of course, but at the same time, by working collaboratively, by sharing our information, we still believe there's a lot of the key things around the world which are uninsured, or underinsured, we should say, and therefore we believe that the proliferation of data, the proliferation of techniques for modelling these sorts of risks can only support the industry in doing a better job and becoming more relevant in the future.
A positive note to end on, Daniel. Thank you so much for talking to us. Great to talk to you.
Thank you.